underwriting than the best of more, and if you don't believe me, ask my Dr. Down. What you mean? You mean Uncle G? Planting seeds for these money trees. Who got my money, please? Everywhere you wanna be, like Visa, MasterCard, American Express. I bought the bank and I bought the jet. I buy apartments, I send checks. Yo, billionaire went undercover, help y'all discover who did it best. Just bought 2 choppers, can't wait till they see the face and they see what I do next. When I walk through the door, I'm talking cash flow. And if you know like I know, you getting cash flow. When I walk through the door, I'm talking cash flow. And if you know like I know, you getting cash flow.
Yeah, and only then do I buy something stupid. How stupid can you go? You can go as stupid as your cash flow.
You know what heals all ills? Deals. Look who went from meals to bills. It's eat what you kill when you're in the field. In the pipeline overflowing, I don't drip, I spill. We don't seek balance, nah, we want extraordinary. If you really knew my dreams, every morning.
Hey guys, how are you?
We got more to spare. Ain't no shortage, baby. Winning by the chopper and another former lady. Talking about the bird in the strap. Say the word and she handle that. Fully loaded, put it at the target, and you know we let it off every man. Got my money, who got my back? You can never get it if you never ask. Big bags, legendary swag. Only one thing better than cash. When I walk through the door, I'm talking cash flow. And if you know like I know, you getting cash flow. When I walk through the door, I'm talking cash flow. And if you know like I know, you getting cash flow. When I walk through, no I walk through, no I walk through, no I talk to, not to, you don't about to do what? Walk in that door.
Hey guys, what's up, Brian?
No matter how much you've already achieved, you will desire to continue.
Let me turn my music down.
Hey, everybody.
All right, sorry guys. Jerry, you want to take over? Can you hear me?
I can hear you.
Okay. And you got screen share?
I've got screen share here.
I see you now. Okay, good. Getting ready to start. Hi guys, how is everyone today? Happy Wednesday. If you guys want to turn on your camera so I don't feel like I'm talking to myself. I see you, Brian. Welcome to our Multifamily Freedom Chasers Debt Financing Zoom call. My name is Shelly Miles. I'm a commercial mortgage broker and an author and a co-founder of our brokerage company, Adventure Commercial Capital. Now, what our company does is we connect real estate investors to lenders. That's our specialty. All right, let's move on. I'm not going to take long on any of these.
Okay.
What do we got next? Okay, today's agenda, we're going to do, I'm going to talk about the community ecosystem very quickly. We're going to do some introductions on who we are, and then we'll give you a minute to give us an introduction on who you are and tell us a little bit about yourself. You're going to get the current debt market update. We're going to jump into our main topic, which is the lender's perspective on the underwriting process, and then we'll have a Q&A section. Next. So here is our community ecosystem. It is a community like no other. It is free education. Most people pay for these education, but we are doing it for free. We have 4 Zoom calls that we do. We do it alternating on Monday nights and Wednesday nights. Monday nights, you will have Trevor Walker. He is doing the activation Zoom. You can get activated with him for the week with a celebrity guest. Then on the alternating Monday, you have BB and Iffy with asset management. When you close a deal, what do you do next? The real work begins. You will learn the fundamental and explore real life scenarios, challenges, solutions for your multifamily operations. And then on Wednesdays, you will have us alternating with Ed and Kevin. What we do is we do the financing part of the deal. You'll get live updates with the current debt market. You will learn what it takes to find and qualify for debt to take down big multifamily deals. Then you have deal sourcing and underwriting. With Ed and Kevin, you will learn how to engage with brokers, source deals, and underwrite them quickly and efficiently. And that is our community ecosystem. I will share the link in the chat so you can, if you don't have access to the Facebook page. Now, if this is your first time here, can you put a 1 in the chat so we can say hi to you? And if you've been here before, welcome back. Glad to have you guys. Hopefully we're giving you guys some value in your multifamily journey. I'm going to share the link here on the chat. Okay, so everybody has been here before. There's no new people. I'm still going to share the link in the chat. You can also find us on YouTube, Spotify, Facebook, which is the link in the chat. Instagram, I'll share Jerry and mine Instagram on the chat here in a few. And then you can also link up with us on WhatsApp. If you go to the next page, they can see that. I hope everybody's having a great day today. Let me know how your day has been going in the chat. Our house is always crazy, so that's how our day's been going. Jerry, you want to take over? I think we've...
Yes, I will. Hello, welcome everybody. I'm Jerry Miles. I'm Shelly's husband. We are the Miles. It's a picture of us and our 2 boys, JJ and Jordan. Jordan is a 9th grader this year, and JJ just graduated from high school this past year. So he is now full-time working YouTube and getting paid for what he loves to do. And Jordan is playing nonstop basketball. So that's what we do in our evenings, is go to basketball games and practices. So, but we are commercial mortgage brokers, and we founded Adventure Commercial Capital about 5 years ago. We've run a construction company for about the past, more than 20 years now. And about 10 years ago, we started investing in real estate. One thing led to another. We'd run into a broker here and there that, when we're looking for money for deals, that wasn't real honest and didn't treat us fairly. So we decided that we could do their job better than they did, and we started our Adventure Commercial Capital Company. And that's how we got to where we are today. So probably got time for 1 or 2 people to raise your hand and tell us who you are, where you're from, a little bit about where you're at in your real estate investing journey, if you'd like to.
No, I could fill you in.
Yeah, go ahead, Edward. How's it
Okay.
going?
Yeah, pretty good.
Good.
Yeah, as you're aware, I've been doing this for quite a while. Been in real estate investing for about, I think we're almost 11 years, but I think I'm still calling it 10.
Yeah.
Have 16 units my own, and I'm invested in about 8 different syndicated deals and looking to GP on a couple of deals right now. So Jerry's a great guy to work with. Still trying to close our first deal with him though. So,
Oh yeah.
but looking at a couple of other opportunities now.
Awesome.
So, and sitting here in Michigan, and it's my birthday tomorrow, so I'm making plans for that, and also to take the kids out trick or treating. So
Nice. Well, happy birthday.
Happy birthday.
well, thank you.
Edward, did you say you signed off on a property management for your portfolio?
And I signed off on a property management for my portfolio. One of my properties is like perfect for Airbnb, but it needs work. So we're trying to negotiate that aspect of it because they want to build that into their property management business as well. And I don't really want to manage it myself. I'm on the road too much these days. So they're going to do what they can. They already have a bunch of people on hand doing property maintenance. So I think if we kind of shift the way they do things, that they can add that to their portfolio, and then I can have one vendor to deal with for everything. So looking forward to that.
Nice.
Oh,
That's all.
and I signed an LOI on a self-storage car wash in Ohio.
Awesome.
So I might be looking to finance that.
Okay.
Little 1.85 million. So
Sounds good. Yeah. Give me a call tomorrow. We'll go over it, man.
okay.
That's awesome.
Look forward to hearing about it.
And
Thanks.
I'm from Michigan too.
Hey, Brian, how's it going?
Yeah, going well. I just started investing in real estate. I have one single family rental in Grand Rapids, but
Nice.
yeah, I'm from Michigan as well. So
Oh,
Awesome.
that's cool.
yeah,
Yeah, I'll throw my contact info out there if you want to.
yeah. I'll put my number and email in the chat. Where in Michigan are you?
I'm in Troy, so I don't know if you know where that is.
Oh yeah,
Okay.
yeah. I've got family kind of in that area: Troy, Livonia, Sterling Heights.
Okay. Yeah.
Where are you from, Brian? What parts in Michigan?
Yeah, Grand Rapids is where I live, and then I'm from Kalamazoo, Michigan.
Very cool. Yeah, Grand Rapids is a nice area.
Yeah, I like it a lot, for sure.
Very cool. Very cool. Well, thanks for being here, man. Good to have you here.
Oh yeah, thanks for doing the video. Yeah, thank you.
Well,
All right.
Do you have time for one more?
Sure.
Anybody? Going once?
I'll throw it out there.
Go ahead.
Go
I am
ahead.
Eric Manton. I'm over in Boise, Idaho. It's a kind of a smaller market, but emerging, growing. I'm attempting my career in wholesaling as we go, but I've been learning multifamily for the last couple of years. So I'm also very grateful for these calls. More than I can explain. They're very beneficial. I'm looking at a lot of distressed properties. Started looking into multifamily distressed properties as well too, because it's a little more bang. But last call we were talking about those sixplex units. We went over them, and price is a little bit high, but still kind of out there in the possibility zone. So
Nice.
there's a little bit of movement happening. Yeah, I found it through an agent. It wasn't like off market or anything.
Okay.
And the seller's just asking too much. He'll do creative financing, but still even at that, it's too much. So either he's going to come down in price or you're just going to pass.
Yeah.
But it's a guy in my network. He owns, I think, I don't know, 6 or 10 units less than a mile away. He's very interested in them, and money's lined up. He's lined up. Everything's lined up except for the seller. So
Yeah. Yeah.
tis the nature, right?
Oh
But
yeah, for sure.
that's current events, and yeah, I appreciate you guys as well.
Oh, cool. We're glad you're here, man.
Thank you.
Glad to have you.
Yeah. All right.
Thanks for sharing. And you guys just, like Brian and Edward did, put your information in the chat so you can connect with each other.
Yeah, for sure. There's been people do business together that have met each other on our calls. So, what are we, 2 years in now?
Yeah, we're 2 years in. Sorry, I muted you by accident.
That's all right. So we're 2 years we've been doing these calls. We've had people that have done business together, that have met each other on these calls. So
Yeah.
y'all make sure that you get to know the people on the call, potential GPs, KPs, and things like that are in this room a lot of the time. So get to know everybody. So the current debt market update, Fed rate, they're still at the 4 3/4 to 5. Since they dropped rates last time, the treasuries have done nothing but go up. I think we're 30 to 40 basis points higher than what they were when they dropped the Fed rate. The treasuries are what determine the rates we pay. So they have gone up. These here, what are the date on these? So these are from yesterday. These are the Freddie Mac small balance loans for multifamily, for loan amounts 2 million and above. 2 million to 7.5 million is Freddie Mac. So if you have a loan amount anywhere, or really anywhere from 1 million to 7.5 million, we can get you under the 2 million at some cases. These are kind of where your rates will be. So if y'all wanted to take pictures, once you jump over that $7.5 million loan amount, the rates will jump down another 1/4 point to 30 basis points or so. So, you know, the nicer, bigger properties get the best rates and terms. This here is the Fannie Mae side. Freddie Mac likes the you know, Fannie Mae likes the more populated areas. If you got like a property in a secondary market, things like that, Freddie Mac is kind of who we're going to go to. You know, you see, you know, we break over the seven mark at the high end, and just down under 5 on the, or just down under 6 in the high 5s on the low end. So the Fannie Mae, it is considered a small balance loan up to 6 million. After 6 million, you go into the conventional space and your rates drop again. So we have had a stagnant market, I guess, over the last 3 years now. You know, just due to the interest rates going up so high and so fast. Unless someone is being forced to sell, they're not selling. You know, we're always running into people that owe more, or owe probably about what the property is worth now in today's market. You know, and if they sell, they're gonna lose all their equity, which means they're losing friends and family's money generally. And so a lot of them are just holding on as long as they can. You know, in the case that the bank starts forcing people to sell and not giving them extensions and things like that, you know, we'll see a lot more deals coming to the market. You know, but like it says here, $2.7 trillion of debt maturing by 2027, $500 billion in 24, $500 billion in 25. These numbers will be higher at some point because all these people that are on extensions and extending and paying to get another year, they're eventually going to have to sell. The banks aren't going to continue extending these loans. You know, at some point it will happen, and we'll start seeing a bunch of deals hit the market unless, you know, rates drop, you know, real fast and in time for everybody to be saved by it. You know, we do have an election coming up. You know, who knows what's going to happen there. One of the candidates is a real estate person and says they're going to bring rates down. You know, so we'll see if that person gets in. You know, there's a chance the rates could drop pretty drastically, which could cause other problems. But you know, it'll be interesting to watch. You know, no matter which way it happens. So we'll all have lessons to learn, I guess, as everything unfolds. So the main topic is the lender's perspective on underwriting. So the first thing to know is there is no magic formula or way of underwriting that makes deals work in comparison to other deals. It's all the same underwriting. You know, everybody underwrites the same numbers, and you know, just no magic formula. The things that will be underwritten is the financials of the property or the business plan. The physical property will be looked at, you know, through appraisals or inspections, things like that. And then the borrower themselves will be looked at as part of the underwriting. So first thing, financials. For long-term debt, we'll need to see T12s on the properties. The T12s will look at the whole thing. If you get stronger numbers, going to a T6 or a T3, and it's improving month to month, we can use a T3 in some cases and run a year's projections off of T3, when we're underwriting for debt. That being said, things that will be added and changed by the lender when they're looking at a T12 is, they're always going to look to see what the new tax amounts are going to be. So if you're buying a property that has a lower tax amount than what they're selling it for, maybe it was valuated at 2 million, now the people are selling it for 6, you're going to end up paying taxes on the 6 million if you buy it for 6 million. So the lender will figure that in on their underwriting, their initial underwriting. Insurance costs. If you don't have a fresh quote on insurance and things, the lender is going to look and they're going to say, hey, what's the average insurance cost in that market? And they're going to figure it that way, until you get a hard number on insurance. And lenders, when they're writing for 5 units plus, they're always going to figure a management fee. So you might be planning to self-manage, whatever it is, the lender's going to go and they're going to say, in this market, the average management fee is 7% or 8% or 3% or whatever it is, and they're gonna figure that in on the underwriting. So just things to note as you're looking at T12s and things. If you're buying a mom and pop type deal, they're not going to have a management fee generally in the underwriting, or on their T12. Things that you can go through, one-time expenses if you're looking through the T12. Some of these T12s aren't real organized, so one-time expenses can be taken out. A new roof or a new AC unit, things like that can be taken out of the expense report. So we're looking at reoccurring expenses and things on the T12s. When we're looking at financials on a rehab situation or new construction, I'm sorry, this is okay. We're looking at new construction property, brand new construction, newly built, ready to go properties. We can go down to a T1. We need the property to be 90% or better as far as occupancy. But once we get that T1 showing 90% plus occupancy, and then we have a good property management company that has a good budget and things on that property, we can use that T1 to start underwriting debt. And we can lend on properties with a T1. A lot of people, will like to see a T3. The lender will take a T1, they'll use it, and then they're going to be 60 days before they close. And as they go, they're going to look at that T2, and then they're going to look at that T3, and they're going to make sure that the management company's budget is what they say it's coming in close to that, to be able to close on a loan. But, when you're looking at a new construction deal, buying one directly from the builder, we can use a T1. And we will not underwrite based on pro forma. We will underwrite on a good budget that makes sense to other properties in the market. When we're looking at financials on rehab and construction loans, we're going to need to look at pro formas. So we're going to look at your money on your rehab. You want to look at your construction cost, your purchase, the holding costs. We're going to look at the whole picture, and then we're going to look at what your projections are, And the lender's going to look at the projections, and then they're going to look at other properties in the market and say, hey, this makes sense. I believe that you can get those rents. I believe you'll be at that occupancy. Expenses are similar to other, same type properties. And, they're not just going to take your word for it on, oh, well, I think we can get 1,500 a month or 16. They're going to look and make sure that those numbers are, are what's, going on in the market in that area. So, when they're looking at these financials for, new, if you're doing rehab or you're building something new, the financials, the banks like it when they see the financials and it shows multiple exit options. So if you're doing a rehab and you look at it and you say, okay, we can do the rehab and we're going to be able to sell it, and we're going to be able to sell it for, 30% higher or 20% higher than what our cost is. They're going to like that. Or if you do a financial showing you that you could either sell it or you could refinance it. Those are the things that they want to see, that there's multiple exit options. So when we're underwriting the physical property, we're going to underwrite the location. And when we're looking at location, they're going to be looking at crime rates. They're going to look at they're going to look at the property condition, but the location, they're going to be looking at the employments in the area, the employment area. They're going to look at crime rates. They're going to look at proximity to the jobs. They're going to look at how close it is. All they're going to look at all the things location wise. They're going to look at the population. They're going to look at just absolutely everything they can look at when it comes to location. They're going to look at the condition of the property, the local job market. Lenders don't like, one employer towns. If it's an oil town in Texas, they're going to want to see that there's other jobs out there that, if that oil business shuts down, that, it doesn't become a ghost town. Or military bases are another one that they just don't like unless there's a lot of other jobs in the area. Colleges can kind of be the same way, unless it's a larger college. Think about the big state schools in our area. We have University of Kentucky, University of Cincinnati, both big colleges. Then we have some smaller colleges. They would like the properties close to UK or UC, maybe not the ones next to Xavier or Northern Kentucky University, just because they're smaller universities, and the big colleges tend to have more longevity. They're going to look at comparable properties in the area. What are they renting for? All those things. And then another thing they look at when they're looking at the physical property is how far away is the ownership. It goes a long way when you have somebody that lives close to the property, having boots on the ground. Freddie and Fannie won't lend on properties for a new investor unless they are there in the market. Generally, they want to see somebody that lives within an hour of the property on their first Freddie or Fannie deal. If you've closed a few Freddie and Fannie deals and they've all been around your local market, now you're buying in Texas or Oklahoma, wherever, and it's across the country, then you could probably borrow on that deal as long as you got good property management in place and things. So. And then the lender is finally going to underwrite the borrower. So the ownership team or sponsor or KP, however you have things set up, they're going to want to see experience. They're going to want to see experience from the team or experience from one or more people. And they want to see experience of comparable properties. So if you're buying a $10 million property, let's say it's a hotel and you've never run a hotel, maybe you've got some multifamilies, they're going to be asking about, hey, can you bring on a partner that has hotel experience? Or do you have a good management company that is going to be managing this? You're not going to try to manage yourself, are you? You know, they're going to be, those are the questions that they're going to be asking because they want to see that the property is run properly. So experience, then net worth. I go over this all the time on a calls, equal to or greater than the loan amount. You know, so if you have a couple of people that, you know, can put their net worth together and qualify for the loan, that would be perfectly fine in most cases. But yeah, so net worth of not the deal, but the loan amount. And then finally, they're going to look at your SREO, and your SREO is your schedule of real estate owned. And so the schedule of real estate owned is going to tell them your, you know, the property that you have as far as your net worth, but it's also going to tell them a little bit more about your experience and things like that. So that wraps it up with main topic, and we'll go ahead and open up for questions if anybody's got any questions. Is there anything in the chat that you know?
Someone said, wow, that is crazy. Just 3 weeks ago, our team got a quote for 5.3% about a week ago. We were up to 5.7. It's hard to believe that we are in 6.4 to 6.6 range. That was when you had the Fannie and Freddie up.
Oh yeah, yeah, yep. Yeah, they're going up. And we have people waiting to sign LOIs right now for deals on our end that are just waiting around and waiting for the treasuries to come down. So
Yeah. Then you have someone, Cheryl said, did you say look at whether employment is a big factor?
yeah, employment is a big factor. You know, if you have, you know, one big employer that, you know, a big percentage of the people in that area work for, the lenders don't like that. You know, they like to see multiple employers. So if those people lose that job, they got somewhere else up the street to go work. So Eric, I saw your hand. I see you too, Brian. Let's go Eric and then Brian. Good.
I do have a question. I understand how syndications work as far as bringing in multiple investors, and you're saying that the net worth of everybody combined equal to or greater than the debts are like what's being borrowed is what.
Yeah, on the GP team.
Okay.
You put people together on the GP team.
Okay.
Yeah.
So I do have a question. If somebody doesn't have a high net worth, but they have a business that is profit producing, but they don't like pay themselves a high salary out of it, would that
Yeah, I
also?
mean that business has got a value. If it cash flows and does well, I mean they don't have to draw a salary for the business to be valuable.
Okay.
So that business can have a value to it that would far exceed what a you know W-2 job would have.
Right.
So
Okay.
businesses, I mean, depending on the business, I mean, it could be 3 times whatever the profit is what the value of the business would be, you know, yearly. So you take that, you know, sometimes 5 times, sometimes 3 times, depending on the business, you know. So like we have a roofing company that we own, and whatever our profit is in a year, we could take that profit and multiply it by 3. That's generally the value of the business on a roofing company. So
Okay. That makes a lot of sense because that's been in my mind for a while.
yeah,
So thank you for clarifying.
yeah, for sure. Brian, I saw your hand, man.
Yeah, I've got kind of maybe a silly question. You talked about different exit strategies, and then you mentioned sell or refi. What other exit strategies are there? You know,
Yeah, I mean that's really the only two. You know, when you've got you know, they want to see that there's multiple ways to get out of the deal.
Okay, and can I ask a second question about
Yeah.
rates? Yeah, well, what was the cause for such a rate hike? I mean, was it the job report?
Oh, with the treasuries,
Yeah,
you know, I'm not real sure how, you know, those are continuing to go up. Everybody's expecting them to go down. You know, we're working on a deal right now with a group that owns a really large hotel in Manhattan, $100 million property, and we're trying to refinance out of a construction loan into a CMBS. And and we've been waiting on the treasuries to come down. And I mean, our CMBS lender that we're using is, you know, hey, yeah, he told us a month ago, hey, everybody's expecting these treasuries to go down. The yields are supposed to go down. We're expecting them to go down because of the election coming up, and they just keep running up. So I'm not an economist as far as knowing all the ins and outs on why, you know, why those are going up. When, you know, we have the Fed rate coming down, generally they kind of follow the Fed rate. But that's where it is right now.
okay.
So if you go to YouTube tonight, you can probably find 100 different people with 100 different opinions on why they're going up right now. But
Yeah.
so, yeah. Does that help?
Yeah, it helps a lot. Yeah. Thank you.
Yeah. So if
If you
anybody
want to
else got
open up
questions, what?
if you want to open up your chat, there's a couple questions in there.
All righty, let me do that. So
Cheryl, she said that's a major hike. People with fixed rates aren't going to be eligible.
how does rates affect refis? Well, when you refi, you're going to take on a new rate. When you refinance, you're going to take on the current rate. So that affects them. You know, so if you would have refied 3 years ago, you could have gotten what, a 3.5 or 4% interest rate. But you refi today, you're going to get, you know, on this hotel, we're going to be 3 points over the Treasury. So we're going to be in the 7.25 range on a hotel refi. So, you know, and when the Treasuries were 2, if you go 3 points over to 2, you know, you're at a 5% rate. So a refi, you know, when you refi, you're going to take on the same rates that somebody would if they're buying new. So, and you know, you think, oh, well, I just wouldn't refi, you know, like, you know, we've got, like, on our home mortgage, we've got a super great rate. You know, we've got all this equity there, but I'm like, oh man, it's so nice having this low rate, and, you know, and the equity's not going nowhere. We can just keep it there. But when you've got a commercial property, and especially these people got a construction loan, they're paying like 11% right now on a construction loan for 30 million. And so, I mean, figure what 11% is on 30 million every year. That's a lot of money they're paying. And when they refi down, they're gonna pull a lot of cash out, and then they're also going to be able to, you know, pay a little bit less. So commercial, you know, also a lot of the terms are, you know, 3, 5, 7, 10 years. So when they're looking at, you know, you do a 5-year term, because if you want to sell in 5 years or plan to sell in 5 years, um, you know, you don't want to go to a 10-year, 7-year rate, because you're going to have a big prepayment penalty. So if you go to a 5-year, your prepayment penalty in 5 years is going to be 0. You can refinance, but, you know, people that did that 5 years ago are now, man, you know, you know, we can't borrow as much as we did 5 years ago. You know, what's going on? We're gonna have to put money into it to refinance. So that's where people are being held up right now. So things that I need for a quote, if we're looking at multifamily, a T12 and rent roll, an OM, a summary of what you plan to do with the property and things we'll need before we would, go under contract with a lender, is we would need an SREO and a PFS from whoever the sponsor is or whoever the sponsor team is. For a DSCR loan, so 1 to 4 units, address, if it's a purchase, we need the purchase price. If refi, we need the purchase price and date purchased and current value. These are simple loans, guys, if you have single family rentals. Monthly rent, taxes and insurance, and the borrower's credit score. And then, this is all we need to get rolling on a loan. And these things can go real quick. We're closing these things right now in 3 weeks' time. So these, DSCR loans. So
Yeah, and if you have, if we have a couple more minutes, I can go and do, I can tell them how to boost their credit score a little bit.
yeah, let me
If
do
you-
the week's verse and then go
How to-
there.
Yeah, I can do that.
Yeah. So this week's verse, Colossians 3:24, whatever you do, work at it with all your heart as working for the Lord, not for human masters, since you know that you will receive an inheritance from the Lord as a reward. So
Just
work
go back up. I have a
on-
couple slides up there. I
Okay.
just got them in there. Right there, below that one.
Okay. Cool.
I'm going to give you a couple of tips on how to boost your credit score within 30 to 45 days, by maybe 50 points. Because you have to have a 680 to close with some of these loans you were talking about, a 680 or
Yeah. With Freddie and Fannie, you need to have a 680 or better credit score.
Yeah. I am not an expert by any means. I just learned all this stuff from boosting my own credit score back in the day. I'm just giving you some tips. There can be many, many reasons why you have a low credit score. I've been using the credit improvement app. I can't pronounce that word. Anyways, so one, go ahead and check your credit score, check your credit report. You can check your credit score at creditkarma.com, or if you have like a a credit card, they usually give you your credit score or a ballpark on what your credit score is. I suggest everybody go to annualcreditreport.com and get a report. This way you sign up with the 3 major credit bureaus, TransUnion, Equifax, and Experian. I think Experian is doing a lot of good things right now with helping you with fraud and maybe boosting your score and stuff. I've seen some stuff recently, but create accounts with those, and 100% of the time when you go into those reports and you check, there's something in there that's not going to be yours. 100% of the time, there's something in there you go in and it's not yours. I've had my sister's stuff on mine, my aunt's stuff, and they only report bad stuff. So all the bad stuff is going on my stuff. So I had to go in, like this was 10 years ago, actually it was like about 12 years ago, and clean up like a bunch of stuff. You can clean up your names. Like your name is written so many different ways, with your middle name, without your middle name, with your initial. Just try to minimize it as much as you can, as much as they'll let you minimize it to your actual name. You can minimize your addresses. Don't do addresses that you've lived there forever. Do addresses like if you've lived there for a year or two, try to get rid of those. The other addresses is a track record of where you live. Jobs, try to eliminate. I had my sister, I'm not a ballroom dancer, and my sister is, and I had ballroom dancing on there, and I'm like, I don't do that stuff. So I had to eliminate all of that. Credit cards, there can be credit cards and like different bad stuff on there that relates to what do you call them? I forgot what you call them. But anyways, you can eliminate stuff that's not yours. You can actually, on those sites, there's like a button where you can dispute them. And if they review it and they realize, okay, this is not this person, they'll take it off immediately. Sometimes you may have to call and talk to somebody. Don't mail in anything that takes forever and it never gets resolved. Loans that are not yours, just go ahead and dispute those or call them. And inquiries, get as much of the inquiries out as you can, just dispute all of those. That will help boost your credit score within the 30 to 45 days. And if you want to go to the next slide, I'm just going to go through this real quick. So how to boost your credit score overall and maintain it for a long time. Here's a breakdown on what the credit score is. 35% is on-time payment. Try to pay your payment on time. 30% is amount owed or credit utilization. Pay off your balances or your utilization below. So, for example, if I have a credit card with $10,000 on it, if you have a credit card with $10,000 on it, try to keep your utilization to like less than, I think it's 2/3. So even if you have like 5 credit cards and they add up to $20,000, keep it less than half, 2/3 of that. And that helps and it looks good on your credit, and they'll boost your credit by keeping your utilization at a lower
1/3 or less.
1/3. I said 2/3. Is it 1/3 or 2/3? I can't.
1/3. You want less than 1/3 of your credit used.
Okay. 10% for most people, it would make the big difference for your credit score in the shortest amount of time. Okay, yeah. So if you keep it at 10%, I guess, I don't know. I don't remember what I wrote that for. 15% is how long you've had your credit cards. Don't get rid of credit cards. Pay them off and leave them. Like revolving credit cards, leave them there. I suggest don't get store credit. Like if you go to Lowe's, don't get a Lowe's credit card. Get a major credit card. And because that hurts, that interest rate is higher on those, by the way, and you only get to use it at that one store. Just get a major credit card. If Lowe's have a major credit card that you can use, yes, I agree. Go ahead and get that. But try not to get like a Macy's credit card, or for the women, JCPenney's or Macy's or whatever. For the men, Home Depot. Try to get a major credit card, like an American Express card that you can use everywhere, or a Capital One card that you can use it everywhere. 10% is types of credit card like mortgage, car loans, credit cards, leasing. So that's 10% of your credit score. And the last 10% is hard inquiries. Now, when we're going to buy a multifamily property and they run your credit score, that's definitely going to be a hard inquiry. I can't say that word, so I'm not going to say it. So yeah, just and even if you get that hard hit on your credit when you're doing those loans, it's fine because it'll drop for a little bit, but then when you pay the payments, it goes right back up within a month. Yeah, and that's it. And like I said, at the bottom, there's this, I haven't looked at these charts in like a long time. I think I did this a few months ago and I never looked at it again. Stay away from store credit cards. That's one of my biggest advice. They have higher interest rate. Get a major credit card. I have not been able to pay credit in too long. A lot of high debt. Too high. Yeah, the interest rates are high, and they're probably higher now because most people are using their credit cards now more than ever because everything's so expensive. You know, the economy is not doing very well, even though they say it is. Most people are putting all of their stuff on credit cards. So you can go to Graham Stephan, and he's got a video, and it explains it a little bit better than I have, but it's pretty much the same thing I'm saying, but I just said it in a quick little thing. It takes him like 14-15 minutes to explain it, and he explains it way better than I do. It's 5 ways to instantly boost your credit score, and that's Graham Stephan. You can find him on YouTube. I don't have the link, or maybe I do. I don't know. But yeah, if you have any questions, I'll try to answer it. And try to pay your, like, if you're paying your credit card bill, try to pay 2 days before the statement, like set up an automatic payment for 2 days before, not an automatic payment, but I guess it is an automatic payment. Just schedule your payment, not an automatic. Schedule your payment 2 days before the statement date. So when they're reporting, it'll report like you already paid and it'll look good on you and it'll boost you. So yeah, that's just from my experience, guys, and some research I have done in order to boost my credit score. Jerry and our credit score are pretty high. I'm not going to tell you what it is, but it's pretty decent because I've maintained it for a long time and trying to keep it, keep it good.
Cool.
So if you have any questions, just ask. I'll try to answer it. I have been able to, okay. I think I've seen that. Somebody said, Shelly, you could do ballroom. You should try. Oh, I have tried. My sister is a ballroom dancer, and she actually, like for our wedding, she was our teacher, and we did fairly well. I mean, we did good. I mean, I dance, but not ballroom dancing. I don't know if I can do the heels and stuff, but she's pretty good.
Her sister's a professional, so
Yeah, she worked for Arthur Murray Dance Studio. I'm sure everybody knows who that is. Yeah, she's pretty good.
cool. So November 13th is our next call. We only have 2 more calls for the rest of the year because of the holidays. So, and next week we'll be spotlighting 2 deals that we have done ourselves and just talking about how we financed them and those types of things and how they went for us. To try to do a little something different. I see your hand, Eric.
I didn't want to interrupt this. This is exciting. I did want to add on though, and especially for Cheryl too. There's one more tip that I heard. There's a guy I follow on Instagram, it's Prada Jones. He talked about credit, like building your credit. And he also suggested never making the minimum payment. So I was looking at Cheryl's comment, like if you are in that state where you're just at minimum payments, he says at least pay a couple dollars over it, because that's another way that kind of put you in a different classification when they're looking at the bigger picture too.
Yeah, that's true.
Yeah.
That's like
good advice. Thanks. Yeah.
Like Dave Ramsey talks about the debt snowball, like you're paying one at a time and making minimums on the other until you get to it.
Yeah.
So even in that process too.
Yeah.
Yeah, just an extra $3 or $5 or whatever it is. Yeah.
Yeah, and if you're just trying to boost and get like a higher credit score, what I usually do is I just use my credit cards for groceries and I'll just pay them off. Like instead of using the cash, I use my credit cards. Plus I get the points and we get free flights and we get free hotel stays. So I just use it for that stuff so I can collect all the points. And then I just pay them off at the end of the month or So, but if you're struggling, I mean, of course, just pay the minimum or a few dollars over the minimum. So yeah, that's good advice,
Yep, for sure.
Eric. Yeah, good advice.
Do you guys
Here's our
talk about how to develop corporate credit independent of personal credit?
I'm sorry, say it again.
Corporate credit?
Yeah.
Okay.
Did you say you want to talk about it or you want us to talk about it?
So I think that's pretty crucial in this business of, if
I mean,
if you have a operations business or something like that and you want to buy stuff at Home Depot and or use it to, if you have a good corporate credit, then
yeah, for sure. One thing about the corporate credit is just, when you first start it, and really, I mean, forever, you're going to have to sign on them, personally. But you get some credit cards, you run them through your LLC, you sign on them personally to start growing them. There are programs out there where you can get the credit cards without signing on them personally, but they do use your credit score to do it. and then it doesn't report. The nice thing about when you use the corporate credit, we have, car loans and all that kind of thing, through our business that are through the LLC. We had to sign on the loan ourselves, but it's through the LLC, and it doesn't come back and show up on our debt to income ratio, which is nice.
Oh,
When you do these DSCR loans, you're signing through a corporation. It doesn't show up on your debt to income. And just like any of the commercial loans, unless it's an SBA or something along those lines, they don't show up on your debt to income ratio, which is nice. And then the more that you use it that way, the higher credit rating you'll get through your LLC. So
Yeah, but if it is negative, it will show up on your credit report.
yeah, if you don't pay those and they're through your LLC, it will show up on your credit report then. But
But
when
the
you're
good thing is it doesn't show up on your personal debt to income ratio,
yeah,
which is awesome, by the way.
yeah, yeah, for sure. So here's our contact info. I'm going to guess everybody had time to grab that. That's been up there a while. That's my cell phone number, my hi hello card. Join the calls. I think come the new year, we're going to be changing up the sequence and the amount of calls and things through the week and the timing and all that. We're not sure what that's going to look like, but through the rest of the year, this is what we've got. So you're muted.
Yeah, go back to the last slide.
Okay.
So if you're new and you join the Facebook page, that's where you're going to get all the updates to all of the events we do, which is 2 times a week on Mondays and Wednesdays. Like Jerry said, we're probably going to be dropping back to once a month, each one of us. So you're going to get just 4 calls a month. And actually, we only have 2 more calls for the rest of the year. When we looked at the calendar, one of our calls fall, we were supposed to have 4 more, but one of our calls fall on the day before Thanksgiving, which we're not going to do. And then the next one on, and the one on in December falls on December 25th, which we are not going to do. So technically we only have 2 more calls this year, one in November and one in December, unfortunately. But hopefully you guys can join us for those last 2 calls of the year, and then we'll start over the new year for sure.
Yep.
Not sure what the new year is going to look like yet, but we're going to be once a month.
Yeah.
Did you do the topic for next?
Yes, I did.
Okay.
Yep.
All right, it's 8:59, and thank you guys for joining Christmas for the MFC.
Yeah, come on, guys. Let's all get together.
Yeah.
yeah.
Yeah, for real, right? No, we always have a house full or something, either our house or somebody else's house. Most likely it'll be our house, but we'll see. All right, guys, thank you. I will leave you with some music. If you can hear it, I've been having troubles with it lately, but we'll see. And you guys have a wonderful night. I'll leave you with some Grant Cardone Cash.
When I walk through the door, I'm talking cash flow.
I don't hear no music.
And if you know, like I know, you getting
I don't hear you
cash
talking
flow.
We will just call it a night.
Money never losing no. But I'm broke, but now I'm living adding digits, comma zeros and some decimals.
See you, everybody.
You would try to test me, yo. You should listen to the lesson, no. Masterminds out of Mexico. I invested though when I let it grow.